Yeah, we are live now. We are discussing risk management. So, but we have had a very amazing trading week since last week till now. So, and I think this week is one of our best weeks so far. You know what I mean? It's been one of our best weeks. So we would like it to be a bit interactive. We have, okay, I know you, Adejo Idris, your name look familiar to me. Then we have God's power. So how you guys doing? Can you just tell me how you are doing with your trade? What is happening? Can someone just know? Let's get to familiarize ourselves with each other. Who do we start with? Can we start with Mensa? Mensa. Good morning, and how are you doing? Okay, I'm not sure you could. If you're not where you can talk, maybe you could. If you can mute yourself and speak to us, fine. But if you are not, you could just send us message. Okay, Vincent Omo Owino, can you just introduce yourself? I know you have told us where you come from, but let's just get to know you a bit. This is Uche Paragon Trading School. We run an academy. So can you tell us if you have a trading experience? How did you hear about us and stuff like that, please?
Good morning, everyone.
Morning.
My name is Vincent Owino from Kenya. First, I hear about you from Facebook. I sent a request, and today I saw a message from WhatsApp, and then I was invited to join the Telegram, and I found the link. I registered, and I have no experience with the trading, but
Okay.
I have interest in trading, but I don't have any experience.
Oh, I see. So you are on a beginner's level.
Yeah, I'm at the beginner's level. Yeah.
Okay, so we are one of the Pan-African Trading School. Our mission is to educate people on how to trade profitably on different asset class and different markets, from CFD to spot to futures to normal exchange like Kenya Commodity and Future Exchange or Kenya Stock Exchange. We can be able to give you lectures on how it works. Then you can be able to even navigate to local investment. You may not be a broker, but knowing much about it helps so that you can be able to work with registered investment dealers in Kenya where you can invest in local investment product and as well invest in international market as well. So you're welcome. We'll be able to, if you like our services, you may be able to enroll on our full-scale programs where we teach you on different courses, especially the area of your interest. If you check our website, you see that we have different arrangement of courses we teach. You know what I mean? So can we hear from you? Which person again? Gospawa Ukoshuku.
Okay, good morning, everyone. Gospawa. My trade so far has been going well from the analysis Mentor Uche gave us. Yesterday, day before yesterday, I did make some profit from the analysis from oil, crude oil, and gold, which I did place a trade. Something really happened that the broker that I was using, I think from day before yesterday, 10 p.m., I don't know what happened. I was offline actually, and the trade went downtrend, and I think I lost about 70% of the profit because I was already on profit up to I think $100. So it just went a little down and I was on lost about $70. And when I checked yesterday early in the morning, I saw that the account has been disabled. So I didn't really know what was going on. I tried to contact the consultants on WhatsApp from Uche schools, and I don't know what really was going on. So that was my experience.
Oh, okay. So you probably you are using our capital funded account, and
Yes.
it's not really by us, it's by brokers. We got to know that information because I believe we are trading with a broker in Nigeria. I think so that information I got the screenshot when they sent it to me is I don't think it's right. I don't know what he did because when we give you the capital, the minimum loss you must have, maximum loss you must have on that account is about 9 to 10%. But from what we saw on that account, it's not up to that. It's $25, which is about 2% to drop down. Your account shouldn't have stopped. I don't know what happened. So you may need to contact the broker and explain more to them. Then if that incident continuously occur, we may stop using that broker. But just that in Nigeria, people like to use local things, so we don't blame them, so they can go for what they want. So
Yes, I do. Sorry,
mm,
I do try to contact someone claiming to be my account manager, and we spoke yesterday, but this morning I've been trying to reach him, and he's hanging up my call. So I don't know what's the fate of the account anymore.
yes, send them an email, like open a ticket, go to your portal and open a ticket.
Okay.
When we give you a capital, we don't run a brokerage or firm, so we work with other companies to provide this capital. Because if you check our website, we don't have any trading platform there, and we're not supposed to do that. So we provide grants through other institutions for people to trade, and any profit you make on that account is yours. You can only share it with the broker who provide the liquidity, because they're the one paying the profit, it's not us. So now, ideally, if you have a drop down of 10%, the account will stop. But from what you see, what I saw on your account, you didn't have up to drop down 10%. So if possibly, make sure you avoid overnight trading in case they usually increase their spread at night. But from what from the screenshot I saw, it's not up to that. I don't know if you didn't share all the screenshot, but from what is shared with us, you're trading perfectly okay. So I don't know. You just have to contact them to see what they can do about it. Yeah.
Okay, sir.
Okay.
I will.
Okay, perfect. So we have Atukunda Morris. Can you just introduce us? Maybe after Atukunda we can start. Hello, Atukunda Morris, are you there?
Yes, hello, sir.
Okay, yeah. Please, you were connected from?
From Uganda.
Oh, okay, from Uganda. So, okay. So, how you doing? And how is it trading this week?
Well, this week I only traded oil, but I left the trade running from Wednesday up to now.
Okay, it's still trading.
Yeah, I'm still trading oil, but so far it's in profit.
Okay, you're on profit.
Yes.
Okay, but yeah, because we are also buying oil. We are not intending to sell oil for now. Someone sent me a message. Okay, it's a thanks for welcoming me. Okay, perfect. So, okay, I think we have to start as quick as possible. Our class will last for average 2 hours. Then if you finish earlier than that, fine. So we are discussing our risk management, and it's not gonna be only theory. We give you practical. So please be ready to take the practical side of it, which is very much recommendable. So we will Okay, I think you can see what I'm sharing on my screen. For those of us who are on our funded program, so you need risk management to be a profitable trader. If you also trade your own account, you also need risk management to be a profitable trader. So some of us are already on futures and derivative platform, which risk management is very, very crucial for you to succeed in trading. So I will just give us a brief definition of risk management. Then we could now go ahead. Then we can go further. I'm sorry, I was trying to connect to my mouse. Sorry, you can scan. Okay, risk management in financial trading involve one, strategies. Then it also involve strategy and practical, or it involve you practicing, like being master of it, like gradually implementing it. Risk management involve practical and gradually implementing it, and it's very good and very essential if you want to have effective risk management. And if you also want to make profit in trading, you need risk management to make profit in trading. Do you understand? It involves strategies. Take note. It involves you practicalizing it. And if you want to make money in trading, profit, you need to manage risk. Then, I know that you must have heard about this management. It's not a new thing. Then there are some things we need to take home with as we want to go into this course. We consider our position sizing. In stock market is called unit, the amount of unit of shares we are holding. Then in derivative and CFD is called volume, the amount of volume of trade we want to go into. Then this is a bit different from setting up a target. For example, in our own trading firm, the trading school is not our trading firm. We have trading firm where we work. Our minimum risk per trade is about 1% to, okay, let's average risk. We take 1 to 3% risk on each trade. That's also the same thing we want to teach you how to do. If you have an account of $1,000, 2% risk is $20. You know what I mean? 1% risk is just $10. So we don't even take up to 10% risk per trade, meaning that for our account to have minus $100 is to be difficult, like if we have a trader on that level. And that is how we have been able to structure our risk management. Because trading is mathematical, it's in figure, it's not in assumption. If you fix it, it works. Especially if you're using algorithm or AI. When you have put those things, those algorithms will work for you. Then there's another component of risk management in terms of stop loss order. So, it's an order to sell a security when it reaches a certain price or limit. Or it's also it helps you to, that's what is called take profit. Also helps you to take your profit because it's also part of risk management. Then we have leverage. Leverage helps you to manage risk. Please just be taking some point of what I'm saying. Taking some point. We discussed leverage, take profits, stop loss, amount of unit volume you are using to trade, and the amount of target you are trying to get put in your trade. Like maybe you want to target 1% or 1 to 3% risk, for example. Like I put here, for example, of if you have $10,000 account and you're risking 1%, that means you are just trading with only $100 of your money. That is risk management. If you fail to manage risk, you put your account and everything at risk. Risk management is the key thing you need to know if you want to be a profitable trader. Is the most important thing you need to know if you want to be a profitable trader. Somebody just join us now. Okay. So now going forward, another way you can manage risk is also to diversify it, which is maybe advanced level. People who are already an investor, they can diversify it. In trading, you can diversify in trading in considering trading other asset class to manage risk. People also manage risk by hedging. People can manage risk by hedging in trading. I will show you how you can also manage risk by hedging. But let me say something important here. When we say position sizing, there are things I would like to let you know on position sizing. On this aspect of our trading, our position sizing, we will put it down to explain about margin. To explain about margin, explain about leverage, explain about equity and free margin. It is a key component for your position sizing. Do you understand? How they interact. So if you're able to understand them, you'll be a very profitable trader. Now, as a trader, you need to know how much capital you are willing to trade or you are willing to risk per trade. And overall based on your financial situation, including your risk appetite. If you check those of us who are using free money to trade, you see that brokers has already put a risk management measure, how much you must not go against. It's like a stop loss they have put on all the accounts, all the account group. You see that some of them put 10%. Last year, when we give out fund for people to trade, our maximum risk was 20%. We are one of the best grant provider in the industry. The last year when we give it was maximum 20%. It means if you are trading, if you lose 20% of the money, we stop you from trading. That's our risk appetite. So this time around, the risk management system has become very much competitive that some brokers even give you 5%. Some people who provide fund for traders can give you 5% minimum. Some can give you 10% maximum. We have about 10% maximum now. That if you are trading without your own money, and if you lose 10% of it, account will stop trading. That's risk management. It means those brokers or those companies have already set up a stop loss at the back end, how much they can be willing to lose, because they can't just lose their money. If you think there's no money, it's money. Those things cost money. But I can explain to you when we go into margin experiment, you now be able to understand why they are doing like that. They're doing what they are doing. Now, the same way you do as a trader, you also need to put your own risk. One, what is called risk appetite, what you have in mind. It may not be exactly what is being on the system, but you already have in mind that I don't want to lose or risk maybe up to this amount of money. Then if you already have it as an idea, you can implement it practically on your platform, and it will help you to be effective. Apart from that, let's say you have it on your mind, you can now put a stop loss or select position sizing, and their leverage can also play along with it. So, and the margin given you will also be part of the whole processes of managing the risk. Yeah. So now, when you want to determine your risk tolerant, you need to calculate your position, determine the amount of capital to risk per trade. I've said that before. Then adjust the position size so that the total loss at your stop loss level does not exceed your risk threshold. This is very important. So you adjust your position to make sure that no matter whatever thing you are risking, even if I had 10 trade, it does not exceed it. If I give you money to trade for me, and I ask you not to lose 5% of it, it means that anything you're trading will be between 1 to 3%, or maximum 4, because if you go to 5%, I will stop you from losing the money. And it's very, very simple. So maybe I just want to be making small amount of profit, maybe in a year or in a month. Even if I make 10% return or 20% return, I'm okay with it. Then on that note, you need to adjust your positions to size that my risk level or my risk tolerance. There are a lot of things we can use to implement that. Even when we are putting our stop loss, we make sure it's fall in line with it. Example of risk management in trading, like suppose you have a trading account with $10,000 and you decided to risk 1% per trade with $100, then you identify a trading opportunity in a stock and decide to enter a trade with a stop loss of 1% away from your entry point. It's as simple as that. Some platform give you risk management in percentage, some does not. Like most of the platform you guys are using does not give you risk management in percentage. You know, you can put like 1% risk. If you put it in percentage, then it will work accordingly. Rather, you can put some of this risk management on point or per price. So that's why our class today is going to be very much practical, where we'll be able to let you know how it works. Now, example of risk management in trade, calculate position. Okay, I've said this again, but let me emphasize, this is a bit different from the one we said before. If the currency pair is priced at 1,200, a 5% loss is 0.06, which is 1.200 times 0.05, which is 5%. You can buy an amount of such that the total loss is $100 when the price changed to 0.06. I think this particular statement is good when we practicalize it. Let's go into practical so that I can be able to show you how it works. Because some of these things are much better in practice than to explain it in theory. Now, let me try to log into the trading platform. So I'll be sharing the slides like interchangeably. Bring those topics we discuss, then we'll practicalize it here. Do you understand? I know someone to be talking to me. Let me know when I'm talking to myself. If you know you're in a very quiet place, we can be interacting. Okay. The first thing we discuss about risk management is position sizing. Right? I think that is the first thing we discuss about risk management. Are you guys there?
Yes, sir. That is it.
So in trading, example of position sizing is lot size or volume. Now, for example, if we are using 0.01 per thread, it will give us 10 cents per price movement. Am I correct?
Yes, sir.
Now, on this note, this is a position size. Do you understand? This is what we mean by position size. This 0.01 now means that you are taking a position of 10 cents per price movement. So, and what it means is this. For example, if Euro USD, for example, move, let's say if Euro USD, for example, Euro USD, move from 1 point, let's say 400 to 1.4001. And obviously you are buying. Let's say you are buying. So you make a profit of 10 cents. Although some brokers can give you 1 cent. Do you understand? Some brokers can give you 1 cent. But the area of 10 cents is the standard in so many bigger firms. Many brokers can give you 1 cent. Or I could just like put it like normal, let's say 1 cent movement to avoid confusing you now. Because I know that some of the brokers you're trading can give you one cent so that you will know. Then if you are using 0.10, then it will be equal to 10 cents. Then if you are using 1.00, it will be equal to $1 per movement. Then if you are using, I don't know if you can see all that I'm typing.
Yes, sir, we can see.
Then if you're using 10 lot, it will be equal to $10. So these are basically for currencies or for FX space. You may have known this one, but it may be different from what maybe I may give you a little bit hit that you may not know much about. Do you understand now? But now, what determines your volume or what determines your volume here is based on the capital you are controlling. What determines your volume here is based on the capital you are controlling. Do you understand? Now, and also, this volume is also influenced by your margin, by your equity, and by your leverage. By your margin, by your equity, by your leverage. Now, let me show you something. On the platform, on the platform, we have what is somewhere here. You see, we have our account balance. We have our margin. We have our free margin. Here is called free fund. Then we have our margin level. Here is where we know about that loss size. I'm sure some of you know about it. But I'm going somewhere, just follow me. When you place a thread, a margin will be taken to hold that thread. And that margin is calculated based on the volume, which is the loss size you are using. And that loss size is now, the volume of loss size you use will now determine how much profit you'll be making per price movement. Do you understand? When you place a thread, a margin will be taken, part of your fund will be taken to open that thread. And that margin is in proportion with the volume, which is the loss size you have selected to open that thread. And that loss size will be determined, that loss size you choose will determine how much money you'll be making from the market. It also goes into, in case the market goes a negative against you, what it may be the potential loss. Do you understand?
Not really, sir. I don't really understand the volume and the margin aspects you talk about.
Okay, perfect. I know some of you may not understand. Let me go back again to explain more. That's why I'm trying to make sure this is enter well. So traders lose, this is a major problem of traders, is risk management. All of us know. You know that in trading, we have balance. We have equity. We have margin. Can you see that on your account? We have free margin. Can you see that on your account? Like something like this?
Yes, sir.
Now, your balance, so your balance is constant. Then your equity is balanced in the market. Or let's say balance on trade. Your margin is amount of money on trade. Then your free margin is available amount of money to use for more trade. I think this may be able to understand. You guys may be able to get this clearly now. Then your lot is volume. Volume per trade. And leverage is let me define it as capacity. Capacity to trade more. Yeah. I don't know if what I'm typing is very much visible and clear to you guys. Should I make it more bold?
It is clear, sir.
Now, this is very important, although it's recorded. I'm sure it's recorded, right? Yeah, it's recorded. Good. Now, when you place a thread, somebody is marking, please stop marking so that people will not get confused. When you place a thread, your balance will be your balance, but your equity will change. Now, a particular amount of money will be taken from your balance to open that thread. For example, you are using 0.01. Let's say you are using 0.01. Okay, let's say you're using 1 lot to place a thread. Now, that 1 lot, $200 may be taken as margin. Do you understand? Under that 1 lot, $200 will be taken as margin. So assuming your capital is $1,000, what will be of your free margin will become $800. Remember, your balance is still 1,000, showing you 1,000. But if you check on your trade, your free margin will be 800. There will not be a margin of 200. It means that $200 has been taken from your capital to place a trade of 1 lot size. Do you understand? $200 has been taken from your capital to place a trade of 1 lot size. Now, if you place another trade of the same lot size, your margin will become 400. From here, it will become 400. Then your free margin here will reduce, become your free margin here will reduce and become like 600. It becomes 600. Remember, your balance is still remain 1,000. For your head, you're claiming that you still have 1,000. You don't understand? Now, those trades you place may even be maybe at a profit of just $2. Remember, you place 2 trades now with 2 lot size. $400 has been taken and kept aside. Then your free margin will now remain 600. And the trade may just be gaining only $2 profit. But ideally, what you have left is $600. That's what you have. It's not the $1,000 you're seeing as balance. Do you understand? Why? Because each trade you are placing, money will be taken from your capital to place that trade. That's why trading is done on margin. I don't know if I'm making sense or if it's confusing. Now, let me show you on the platform. You guys are quiet. Probably you guys are confused. Now, let's say we sell oil, because I would like to sell oil. Oil may drop more. The buying is not really too strong, but we're expecting buying probably from next year. Let's say I place a sell here on oil. This is $10,000 account. Please just follow me, because this is the area you can understand risk management. This is my balance. This is my margin. I think my margin is 0. There's nothing there. I think so, right?
Yes.
My free margin is the same as my capital, free fund.
Yes.
Perfect. So my free margin is the same as 100,000. I'm a margin level, margin percentage, margin level which is in percentage is 0 because there's no trade. Because there's no single trade. So now I'm placing a trade. Since the account is big, let me use one lot, like 10 lot size. I'm teaching you risk management in practical. Let me place a sell. One of the reasons why I want to place a sell is I'm perceiving based on the trend. The market may just keep, I'm not giving analysis on trade anyway, but let me just assume I want to place a sell. Whether it's buying, I'm not placing this sell to gain or to lose. I just want to show you how it works. Okay, sell, I think. I place a sell. What did you see here, guys? Did you notice anything here?
Yes, I noticed the margin is now having a figure.
A figure, which is $11,000.
Yes, sir.
Then, did you notice anything here?
Yes. Also, the free funds reduced in numbers, and the margin level has just 900.
So, if you add this margin to this free margin, it will give you this thing. If you add this margin to this, it will give you this. Now, here, my profit is not yet coming, it's minus $100. The more I gain here, the more my free margin increase. The more I lose, the more my free margin reduce. Do you understand? The more I gain, the more my free margin increase. So what is free margin? Let me use the time you understand. Yeah, free margin is the capital you have to trade more. The capital you have, like the money you have to you want to use to trade more. That's free margin. It means free fund. Do you understand now? It means free fund. Do you understand? It means free fund. Now, this is 10 lot. And 10 lot is technically $100 per movement, per price. It means if the price I bought at this price, please, once you're lost, let me know. You need to understand this thing. If you don't understand this, you end up blowing your account. I bought at 73.84. And the market is at 73.84. And this is what they charge me already. Okay, that's what I sold. I didn't buy. I sold, it was a sale. And this is my volume. You see how I told you both volume and whatever they like interact with each other. Now if the market dropped or go up, whatever. Let's say the market goes up from 73.84 to 74.84. That would be 100. Then you multiply 100 by 100. That will give you how much? That's 10,000. Do you understand? If I multiply 100 by 100, I think it's 10,000. Hundred times 100 should be 10,000. You guys are quiet. Yeah, it's 10,000. It means, assuming I put a stop loss of 100 pips, I'm already risking 10% of this amount of money. Do you understand? If I put a stop loss of 100 pips, I'm already at the risk of 10% of this amount of money. For example, if by chance this trade did not gain, and market keep going up, getting to 74.84, I have minus 10, then I'm already at risk of 10%. Let's say it's a funded account and I'm not supposed to lose more than 10%. What is going to happen? It means I'm already at risk. It should, if I didn't get this market and this market hits stop loss, I'm out of the capital. Now, on this note, what do you think I should do? Or what do you think that should be the appropriate risk or appropriate measure to take? Let me know whether you're following me. Please answer me this question.
If you place
Yeah, your voice is breaking.
hello,
Yeah, I can hear you.
what you should risk is like place the bet $1 so that the risk management 1%. That's for $1 loans.
Sorry?
I said, hello.
Yeah. I can hear you. Sorry.
What you should do is place the sale with $1 so that the risk management is
Okay.
$100 loans.
Okay. Now, perfect. Remember, we are talking about risk management in practical. You made a point. Who else is confused? Please let me know if you're confused. Even if you can't talk, just type it. I'm confused. I'm confused. I'm confused. Who else is confused, please? And who else understand what I'm doing?
Yes, sir, I do understand.
You understand?
Yes, sir.
Okay, perfect. Now, like someone say I understand. Now, this account is losing 1,300. When I close it now, this margin will be returned to me. And of course, this loss will go. I'm closing it. Now remember, $10,000 was taken. But at the end of the day, part of the money, assuming it's profit, Once I return it to, the money will still come back to me. Now, I'm closing it. What do you notice?
I noticed the balance has been reduced and the margin level
Has
is
vanished.
empty. Yes. Yes, sir.
Now, that's the point I'm going, the where I'm going. Just follow me. Let's say this account, I have to risk only 5%. Okay, 3% per trade. 3% of $100,000 is $3,000. Right? 3% of $100,000 is 3,000. It means, what to come in? Okay, yeah. So now, $3% of $100,000 will be $3,000, and 5% will be $5,000. So what I will do is this. Remember, I told you that one lot equals to $1. And on this note, it means 3 lots will be equals to $3. And this on currency, not on commodities. And 3 lots will be equals to, so 10 lots will be equal to $10. Sorry. On volume. Now, on commodities, 10 lots will be equals to, okay, no, sorry, 1 lot will be equals to $10. Yeah. And I am to risk only 30%, only 3%, which is about $3,000. If I place a trade on 1 lot and it goes against me 300 pips, or it goes in my favor 300 pips, either way, that would be $10 times 300, and I would technically make $3,000. I think I'm right.
Yes, sir.
Then, if it goes against me, I will make minus $300. I'm going somewhere, just follow me. I will ask myself, that's why I said my appetite, risk appetite. If you check our note, I mentioned risk appetite. I will ask myself, does this thing fall in line with my risk appetite? I will ask myself if this thing fall in line with my risk appetite. It's something you and I will answer. If I said no, this is 300 pips, and Mensa, you have been with us. I told you about price movement, like price pattern, like on a price action, we talk about how things has behaved. So you may be able to see that it's possible that the market can go up to this price before reversing or whatever. You know, I don't know whether you can remember the cost that we did. So now I will know that, okay, it's possible that the market can actually go against 300 pips against me based on the trend we are seeing in the market. I would tell myself no or yes if I can go in on this. Then 5 lots. 5 lots will give me $5. Sorry, not 5 lots, 0.5 on oil will give me $5. That's 0.5 on oil. It will give me $5. And $5 times 300 will give me $150. Sorry, $1,050, $1,500. Now, on this note, I'm already risking 1.5%, not 3% of the money. Do you understand? I'm risking 1.5%, not 3% of the money. I will now ask myself, is this thing okay for me? Remember, I don't want to go, I just want to risk between 1 to 3% of each of my trade. If it's not okay for me, I may come back again to use 0.30, which will give me $3 per movement. And $3 per movement times 300 will give me $900. Yeah. And $900 is about 1% per trade. And I'm having $1,000, $10,000 account. This is also the same thing you could use on $1,000, $100 account. Try to understand. You see this one now, I will say, okay, this is okay. Because I don't want to go above 5%. I will place my first trade, whether buy or sell, using 0.5. Now, I'm trying to deal with, talk about my tolerance level and practical level of the risk management. I can say, okay, my first trade now on oil will be 0.3 because my general risk level is I see 0.3, that which is 0.30, then I'll place myself. Now, as I place myself, look at what was taken to keep my trade. What was taken to keep my trade is only $300. So now it means what I'm risking into this trade is also not up to 1% of my entire capital of 100,000. Because what is keeping my trade now is $300. Not that $10,000 I was using, meaning that I was using 10% of my capital per each trade. Do you understand risk management in practical? So each of these trades now give me. Now, what this means is that, you know, the market is going up and I'm selling. I'm using psychology on you. The market is going up and I'm selling. So now what this means is that, assuming this market did not drop and keep going up from this price I bought 73.97 and goes to 74.97, 75.97, 76.97 will be 300 pips. It goes to 76, which is somewhere here. Somewhere here will be 76.97. I will be having minus 300, minus 900 loss, which is like 1%. less than 1% of my capital, and it is my entry one. Remember, the class is going broad. It's my first entry. It's not that it's my last entry, and it's not also my maximum risk. I don't know if I'm making sense. I play the trade and I'm losing 300. I'm having minus $900, and it's my first entry. And market has gonna away 300 pips. And me and you, Mensa, in your one-on-one class, we discussed that sometimes if market goes up to 300 to 400 to 500 pips, sometimes it can rebound. Within that 300 pips, if you do not go, if the market did not rebound, and I'm just on less than 1% risk, should I be panic or should I relax?
You will relax.
Perfect. I may relax, even if you go against me 1,000 pips, which is about 400 pips, and it may reverse it. Also remember that I'm not just guessing. I'm placing a key strategic trading, key one, the area that I will gain. Monitors are playing on here. It's not just risk management. Okay, I was okay. Let me go in again. I will place a second sell, maybe here. Or if I want to use the current market reality here, I can look for another, maybe, let's say from here, the market form a resistance. Assuming the market form a resistance here, because here was previous resistance. Then I'm getting to this point from a resistance, which is average 500 pips. I can place another sell with the same 0.3, or I can say 0.4 with 0.4 here. Something that's bigger than my first entry, 0.4. When I place that sell 0.4, it means I'll be getting $4 per movement. And the other one, I will also be gaining $3 per movement in reduction. So technically, I'm getting $7 per movement. And the paraventure, the market started dropping from there, from here, down to 300 pips. Before it will get to that point, I've already gained about $500. Because, I mean, before it will get to this point of my entry, that the other one is giving me minus. This point of entry, that I've had about 900. You have to calculate 400 times that 300. 4 times 3. 4 times 300, which is about $1,200. I've already gained $1,200. That $1,200 will be about 1.2% of my capital. That's my target. And the other one, which is reducing to $300 each, has also reduced to 0. Do you understand?
Yes, sir.
Is this too complex or easy?
Well, for me, it's something I need to come back to watch, but it's a bit complex, but I do understand later.
I know it's a bit. I know it's a complex. Risk management is the most important thing. Okay, let me go off the platform again. Who's understand? Who's following me more? Somebody drop a message. Let me check. It's difficult to understand. Okay. Someone says it's not difficult to understand. Perfect. Don't worry. The class is recorded. You can watch it over and over again. With risk management, you must, not you need, you must understand it. It's a must. If you want to be a good trader, you must understand risk management. Something's happened on my system which I don't like, and I've been trying to fix it. Let me know if I can fix it again. You must understand risk management. It's a must. It's not something you will. If you don't know risk management, you will lose money. I want to set up some. Okay, what I will do, give me the bit is also recording. Give me 1 minute. Let me restart my system. That's something I'm not comfortable the way it's running. So let me know if I can. Guys, I'm back. Sorry, I just have to restart my system. I want to connect my mouse to it, so it's not really connecting, and I don't like to use the computer mouse. I like to use the standard mouse. So can you hear me? Where are you confused? Just tell me where you're confused. Anyone, please. Just tell me.
Sir, hello, sir, can you hear me?
I can hear you.
Sir, not that I'm confused. I'm not confused. I understand what you're saying, but just that we that is using $200, $150 entering the market, that we have not started trading. No, we are just there flipping. That's what I understand. Because if we say we should use $100 with this risk management, maybe 1% of $100 would be $1. So we have not started. That is what I just think.
But there's no way I will teach you excessive risk management of $100. Maybe you have to gamble it. That's why people with small money can take any risk they want. Let's be honest. So you're using $100. For you, it may be small money to you, sort of big money to you. But people with $100, I see them, they can grow it to any amount because they don't care. It's just $100. But where you have 1,000, 10,000, 100,000, $1 million account, you can't be talking about what is 1%. 1% is big amount of money. For example, we don't risk more than up to 3%. Our risk is between 3 to 4%, even before the pro-firm thing came up. Do you understand? One, if I have a $1,000 account, 3% is $30, which is enough per trade. If I have 5 trades in a month and all of them gain, that's $30 times 5. So what are you telling me? $30 times 5 is $150, and which is enough, and I save my money with me. So I'm not trying to, I won't do something that I want to get 30% in a week. I'm not saying you cannot get it. You can get $300 in a week. That's why people blow up account anyhow. People that blow the account anyhow does not mean that they have not gained. Some of them get big money before. Some of them have turned $1,000 to $6,000. One day they blow all of them because of excessive risk management. You don't understand? I've not heard somebody say, we've been trading, the account grew to 15,000. So I don't just know. I enter Euro US, enter this before I know it, they do it why. It's not like maybe somebody wipe you, it's the risk management. You know, when your risk is high, it's not good in anything. Do you understand? Which is one of the reasons people liquidate, even some companies, some fund managers, they blow up account because they refuse to adhere to risk. This I'm telling you that you can also scale it from 1%, you use the same approach and increase. For example, if I want to take 50% risk on my margin, I already know how much it will go. Okay, let's use the platform I'm using because this you have to implement it on the platform you're using as well. We use 0.0 is 0.03 and the $300 was taken as margin, right? Right?
Yes, sir.
Now, that's the same thing that will be taken if the account is $1,000. That is the same thing that will be taken if the account is $1,000. Because you may have all the money there, you can decide how much risk that you want to take. Now, let's make it simple. Your balance is $1,000. Then your lot is 0.0. Okay, let's say on currency is 0.30. You know what I mean? Because currency is we give you like $3 movement. Then you imagine will now become $300. So it means 30% margin. Then so your free fund which is called free margin, we remain $700. Is it not so? Then PIP would be like price movement. We become $3. So you become $3 per movement. It's as simple as that. So now on this note, if you put here SL 150 pips, 150 pips. So you'll be expecting to lose $300. 3 times 3. 150 pips. You'll be expecting to lose 3 times 150. Sorry, I'm very bad with mathematics. Let me not get something wrong. 3 times 1. Are you following me? 150. Okay, so that means even if you put a stop loss at 300 pips, that means you'll be at risk, at a potential risk, because of it may not hit your stop loss. We're just talking about risk management, so that's why you're talking about loss side now. We're not talking about profit. We're talking about how to manage risk. That means you'll be at a potential of minus $400 should your this trade hit your stop loss. It's as simple as that. That's by putting 0.03, which is like 30% margin, like 30% risk. Who asked me that question? Is it God's power or overcomer? Who raised that this thing? Are you there? Guys, just talk to me. I can't hear anybody.
Yes, I wasn't the one that made that.
Okay.
That gave that question.
But now, are you following? Are you following my analysis on risk management now from the screen?
Yes, sir. I am following, but a bit confused.
You just tell me where you're confused.
Okay, from this margin, that is the percentage, and the stop loss. The way you explained it, I don't really get it.
Okay. Now, you know that when you place a trade, you will use a lot size to place a trade. And each lot size you use, do you know about lot size?
Yes, I do know.
Now, just explain to me what you know about lot size.
Okay, lot size is talking about the amount of money you're willing to risk by any trade.
That's not lot size. Lot size talks about the volume, the unit you want to hold in your trade. Lot size talk about volume, the unit you want to hold. And that lot size now will determine the margin the broker will use to hold that trade for you, to open that trade for you. For example, we are giving you guys $1,000. It's on a margin account. We provided fund that enable broker to issue $1,000 to you. Do you understand?
Yes, I do understand now.
So now, what that means is this. Let's say you use 0.01, which is 1 cent per movement, right? It means if market goes move either in your favor or against your favor, it's 1 cent. That's the volume or the contract you are holding in the market. No, so now a broker may take only, a broker may take only $20 to hold the trade, to open the trade. It means even me, if I want to give you $20 to trade, maybe if I'm getting the money from a broker, I may not give the broker the exact $20. I may give the broker maybe $10 to give you $20. So margin is holding it. Now, each of your trade will be gaining 10 cents. Someone is moving the screen. That's promise or what you're moving our screen. Look at what you're doing. So you shouldn't move the screen. Do you understand? I know that risk management is the most important aspect of every trader, and that's what some of where everybody's stuck and run away. But if you understand this, you become a good trader. Now, this is 0.01 margin. This is 0.01 lot, and this is the margin required. So even if you have, even if you have a $1,000 account, okay, so somebody used $200 as example. Even if you have a $200 account, so even if you have a $200 account and $20 margin is taken from you, that would be, yeah, margin is set by broker. The loss that you select will determine the amount of margin the broker will give you. These are the things that you need to observe. What margin does a broker give? This would be 10%, right? Yeah, 10%. Who asked me that question? Thank Godswill Overcomer. So it means you are trading with 10% of your money with your broker. If the broker is giving you $20, it is taking $20 from your account to open a trade with 0.01. Then, because of that, what will remain as your free margin on this trade will be $180. It's as simple as that. What will remain as your free margin will be $180. So from this $20 margin, from the $20 margin, then you can determine your SL. Now that is what I talk about. We are talking about risk appetite. I think appetite is should be A. That's where I now talk about risk appetite. Because of, you know, that broker is giving you $20 margin. Now, under this $20 margin, it means if the market goes against you 100 pips, you will lose $10. If it goes against you 200 pips, you lose $20. You ask yourself, is this okay? And $20 is 10% of your money. Assuming it's money given to you to trade and you lost 10%, maybe the broker may stop you from trading the account. Now, if ask me whether the broker is the one that gives margin, yes. Let me show you how it works. Now, when you come here, okay, let me open my platform again. Everybody's quiet. Once you're able to scale up this level, believe me, you can never fail in trading. But it's easy. It's not difficult to scale. It's not difficult at all. It's the most easiest thing. Now, let me show you guys something. Maybe I may develop another way of teaching you this one. So if you become too complex, it is not really complex, but it's more practical. You can't talk of risk management without practicalizing it.
So I have a question.
Okay, but I want to share the screen too. Ask a question. Okay, sorry, before you ask a question, let me demonstrate that answer. Somebody asked me if it's broker that give the margin. Yeah, now look at this account. There's no margin. Now, because of there's no trade. So broker give it automatically. Now, forget about here. Forget about this balance. Let's just assume our balance is $58. Let's assume, because I'm using the lowest margin, the lowest lot size to place the trade. So I will use 0.01 here. Here, 0.01, which is the lowest. And I'm going on Euro USD. Are you following me now? I'm going on Euro USD and I'm placing a sell. Then I click sell. Check the margin now. Are you guys observing? Check that the margin will change. I'm placing a sell. So the broker give me $2. Remember, I have 58. I will assume that this $98 is not real. So the balance, so this the 98,000 is not real. So what is real in this account now is $50. I'm referring to those who are trading with small money. So let's assume what is real money. The capital is $57. So it means I'm using $2 to place this trade. You see how the broker has given a margin. And this $2 is not up to 10% of 57 because 10% of $57 should be 5.7. Now this is a margin of 0.01 lot size. Technically 1 cent per movement is 1 cent per movement. So it means if the market goes against me 100 pips, I will lose $1. 200 pips, I will lose $2. So for example, if I come in here or under here and put a stop loss on point, like a stop loss, on point, let's say 200. You see? So what is gonna be the outcome will be just be $200. So will just be okay. No, not $200. I don't know what this broker is giving. It should be $2, not $200. Assuming it's 0.01, but this broker is not giving me the same. It's giving me 10 cent value. This broker is giving me 10 cent value, but here it's reading at 1 cent. Check. I'm on 00 now. See, look at 2 cents. So it's not counting on 10 cents. So if I put my stop loss at 200 pips, it's supposed to give me $20. Obviously, it's $20. Look at it, it's $1. Probably that is this broker, but other brokers may give you the same different thing. That's why I ask you, make sure you know what a broker is giving. Like I've gained 10 pips now, I've gained 13 cents because each of the movement give me 1 cent per movement. So if I put 200 pips, I'm supposed to have only $2, which is like 2%, maybe around 2% of $58. Do you understand? So now, when you go to your brokerage website or platform, you could like experiment it, try to know what volume they give you per movement based on each lot size, because from here is cents. It's not based on, it's not up to 10 cents. If it's up to 10 cents, I should be getting $22.8. So this 1 cent movement, 1 cent, 0.01 here is giving me 10 cents. And the broker give me only 2 cents, only $2 to open the trade. Now, if I have minus $2 here, it means I've lost all my margin. Then my free margin will be taken to hold the trade. As long as I have not had minus $2, this my free margin will be constant until I have minus 2 loss. Meaning if I have lost all my margin, then my free margin, which is my free money, will be taken to support my trade. That's a question.
Thank you. So my question is this, like I've mastered how to calculate the loss size using position size calculator on forex. But when it comes to commodities, I'm mostly confused because it doesn't align somehow. I don't know.
Yeah. It doesn't have a lie. I know. That's why we need to know it in our head. It's not everything that is on the system. You know what I mean? And different brokers. Somebody shared a screenshot with us. I don't know who the person is. So we're trying to allow him trade. The broker is using. We asked him to use 0.0. Is it 0. I think it's 0.30 on I think on Euro USD. In our thought, we thought it would give him 30 cents. You know what I mean? Like 30 cents on Euro USD, but we were surprised. It was they were giving him $3, which was high. So different brokers still maintain some standard volume, while some of the brokers have reduced the outcome of those volume. That's why you need to check it first. Then what is called on a brokerage website, then what is called instruments specification. You check it on any brokerage website. You see the specification of the instrument they're offering and the volume attached to it. You need it to first understand the volume any broker is giving and the margin they need to open a trade. Now, this margin is also decided by leverage. I'm almost run out of your time. This margin is also decided by leverage. You know, I mentioned leverage. Like leverage is about capacity. Let's say you have $1,000 account, and your leverage is 1.500. It means you have more capacity. It means $1,000 times 500. Of course, which will be almost like 500,000, I think. Yeah. It means you have capacity to hold $500,000 position using $1,000 account. Now, someone else have the same $1,000 account, and is using 1.50 leverage. So it means he'll be having 1,000. He will have a capacity of $1,000 times 50, which is $50,000. Do you understand? Now, do you notice now that you guys have the same amount of money? You guys have the same amount of money, but different capacity. Do you understand? The different capacity. Broker will check it. So now, when I place a trade with one lot, let's say this person place a trade with one lot, it will give you the same $1. This person too with one lot with one lot, it also give him the same $1. But now, where is the difference? The difference is, sorry, I want to put $1 here. Just take note, this should be $1. Now, the difference is that this person can have more position than me based on margin. So now, if they give me $1 here, $1 here with $1 here, my margin level here will be lower. And I would say lower free margin here. My margin level here will be low. While here, my free margin here will be high free margin. High free margin. High. So it means I will be able to trade more money on this account. I mean, I can have more volume, more lot size, more capacity. In fact, I can have like 10 threads or 20 threads here. Here, I can have like 20 threads because I have more leverage. While this person can only have maybe 5 threads because he has less leverage. Do you understand? I can have more volume here because I will have more money. The more I place the trade, the more the broker give me access to trade with almost all my money because I have more. While here, broker give me less access to trade, but the margin could be the same, but free margin will not be the same. Now, that's where some account leverage helps you to manage risk, because even when your motion is in place, because you have a lesser leverage, you want to place some trade, the broker will ask you not enough money because you need some money to open that account. Now, you may have a trade that is running. Okay, let me give you the practical before we close. I've almost run out of your time. So can I use 10 minutes of your time, please?
Yes, sir.
Okay, perfect. Now, let's go back to trade. So now, we want to practicalize leverage and margin. Oh, I don't know how much leverage on this account. Okay, let's because it's already open before you guys came. I don't know leverage. Now, let me show you something. Let me place a trade with big lot size, sell Euro USD. My margin is 10,000. Let me place another sell too with big lot size. My margin is 20,000. Let me place another sell with 80 lot size. My margin is 37,000. Probably I'm on a high leverage and my free margin is reducing. Assuming I'm on a low leverage, I may not be given more access Probably this account is on a high leverage. Then let me put another sell. My margin is 58,000. Remember, my free margin is 42. It means I've used half of my money into the trade. Remember, the market is still at the same place, just almost at the same place. Now, let me put another sell. Then my margin is 77,000. It means this account must be on a bigger leverage. If not, it cannot place this type of trade. Let's say I'm using small amount of leverage. The broker will tell me, no, I don't have enough margin. Now, let me place another one. Then my margin is 2,000. Now, remember that, as you can see, my free margin even went on negative now. Now, my free margin is 2,000. Remember, each of these trades gave me about $10,000 to place it. Let's place another one. You will see that it will not enter because I don't even have up to $10,000. Remember, each of the margin, if the position, $10 was taken. Now I don't have enough. So I have 6,000. So let me place another one. So what did you see? Watch here.
Not enough money.
You see? What did you see?
Yes. Not enough money.
But here, is there not enough money here? So this is your money. You have almost like $90,000, but they're telling you that you don't have enough money because all your money has gone into trading, which is the margin. Then you see that your free margin is negative. It means that you don't even have money again. Every money is into trade, even though the trade is just running at about 15,000. This is a 15% loss of your capital. What this means that you have taken all your money into trade. So now, when I'm gaining, if I start to gain this market, my free margin will become negative, will become positive. But my margin will be constant because that's all the money has gone. Now, brokers give me access to this thing because I have a high leverage. That leverage means I have a high leverage. That leverage means I've asked him to give me access to trade more. Do you understand? So the high leverage means the broker has given me access to trade with almost all my money. Now, if I want to reduce it, I can close some positions. Like now, my free margin has gone to positive because probably I'm about to gain. So when I close some position, my margin will start returning back to me because of I'm closing my position. But in a situation where there was no much leverage or my leverage was low, broker won't have allowed me to use all my money to trade because I've already put my trade on a low leverage. That's what some of the funded account see is on a low leverage because if the money is on a margin account, they won't allow you to take a necessary risk so that you won't blow the account. It's also on this level that you can also blow your account. If your leverage is high, then you could trade more, you could be triggered more, even though there's a loss size you are supposed to control. Now, there are this set of parameter now can give you chance to trade almost with all your money, even though the loss size or the stop loss is there, and you did not even put a stop loss to even. In fact, on this note, whether you put stop loss or not, it doesn't matter. Now, let's particularize something again. Now, let's say I close some of the positions. You see, let's close one position. For example, this one. You see that my margin has reduced and my free margin has increased. A broker has returned back some of the money. Let's close another one. Then you see that my margin has also increased to 54,000. Part of my money has come back, and I have about 33,000 to trade more. Then let me also close another one. You see that my margin has also then let me go to another one. Then you see, let me close this one. Then kind of you see that what is holding the market, what is now in the market is 27,000. So my margin has finally like reduced to almost like 30%. Now let me close this one. Then you see that my margin is now 10,000, and my free margin has increased. Did you see what happened?
Yes, sir.
Any question?
So I have a question.
Okay.
So like you are closing this position that was open. Now, the moment you start closing it now, I noticed that the actual the account value keeps like it's not really that increasing the way you are closing it, but just the free funds and the margin is what is increasing and decreasing. So I don't know if this account value is in part, like when you are closing that market, is it that the money is returning back to the account value, or is already gone?
The money is leaving your margin. Your balance is constant when you're trading, but your margin, so you know, on MT5. So let me get it clear for you with you. On MT5, account value is called equity. No, there's no equity here.
Yes, sir.
So MT5 will give you balance, equity, and the margin free margin. So there's no equity here. There's no balance here. So here is just value. So this value is the equity. You know what I mean?
Yes, sir.
So the value here is equity. That's why it's changing, because when you're making money, your equity will be increasing, and when you're losing money, your equity will be reducing, but your balance will be constant. Now, what happens is that part of the money that was holding the trade, that was taken from from you to hold your trade as your margin, has all returned back. Now you have enough free margin. Free margin means free fund. These people use the right word that can easily be understood by everybody. Free fund. More money you have to trade, more of your money you have to trade. And now, when I close this trade and there's some profit, then this margin will vanish. It means I'm using $10,000 to be earning to be gaining $650. Before it was $1,000. This profit I'm getting here, I'm using $10,000. On a risk management by application, I can ask myself, what loss size can lose this money? Can lose 10,000? I may put my stop loss in a way where I will never exceed this kind of loss. Or if it's not okay for me, I can reduce it. So what I'm trying to say in the conclusion is that your volume, which is your loss size, plays a huge role on the margin the broker gives you. And now you can use it to also determine the outcome of your trade on a stop loss level, in as much as you want to get it on a take profit. What we're discussing about loss here, because we're talking about risk. Do you understand? That's why we're talking about loss. We're talking about risk management. How do you manage risk? This class cannot finish today. There's a lot to learn, but thank God it's recorded, so that you guys can take your time and digest it. It's just 2 hours, maybe 15 minutes of course. So you guys can take your time, digest it. We'll still come back again to discuss risk management in different segments until you're able to pick a point. Let me give you a guide how you can be able to to understand more. Before you start to watch the class, the videos, or even now as we're talking about, you ask yourself a question. I want to understand this area. Do you understand what I mean? So you could start by asking a question. Set up questions for yourself. Try to look for the answer while you're watching the video. How much am I risking here? Okay, I want to risk 10% of my money. What do I do? You know what I mean? Okay, I want to risk 3%. What do I do? Okay, what is this loss size all about? So it will help you to understand those things that is confusing you in your head. And voice it out. Once you voice it out, then you can get the answer. Any question? So let me get the feedback from you guys. What do you think that? What do you understand by as risk management? Is it the most simplest way of learning or trading, or the most difficult way?
For me, I do understand part of the teachings, but it's a bit complex and it's not something that you have to digest in a single learning. You have to keep coming back to it. But I do understand the teachings and it's effective. At least I have an idea of what risk management is.
Okay. So who else?
As for me, understand because I've been using position size calculator to do my risk management for this now. So I don't understand it very well. I'm just trying to get more understanding when it comes to commodity, because commodities seem to be kind of different when calculating them. Because commodities seem like a 0.01 loss size and size. It's not the same as 0.01 loss size and commodity. So that is where I want to like get in the activity.
Yeah. On commodities, use this format. It will help you. Commodities. Like 0.01, we give you 10 cents. Then 0.10, we give you $1. Then there's no 1 cent in commodity. Then 0.5, we give you $5. $5. Then 1 lot, we give you $10. Do you understand? Then on currencies, let's say FX pairs, 0.01, we give you 1 cent. 0.10, 110, we give you 10 cents. But also confirm from the brokers you are using. But I'm not giving you general information. Confirm, but most of the brokers are like this. Then 1 lot, we give you $1. Do you understand now?
Yes, I understand that.
Yeah. This for FS pairs. So it's a bit like different, but just take your time to understand. If you understand this one, then you can now be able to know. Let's say now you are trading forex and you're targeting to and you are targeting maybe $30. So 1 lot is just 1 times 30, then you get $30. Then if it's too much for you, then you can say 0.10. The same way we say 0.20, 0.50. Like, okay, like in FS, I don't put 0.50. If I go in here and put, if I put 0.50, then it will be 50 cents. So the video is available for you guys. We'll make it available for you to watch again. And we still have another meeting on risk management. You need to understand this thing. If you don't understand it, in fact, it's huge. We didn't even go into trading. I wanted to go into trading on risk management, trying to show you how we do level 1, level 2, level 3 entry, how we even use it to recover loss. Let's say we are losing money. How do we counter it and recover? It's on this step. It's deep, and this is what makes you a trader. Forget about all analysis. If you're not able to follow this one, it can never be profitable in your own trading, in trading for others, or in trading for companies. This is the key area you need to understand. Do you understand now? So I have to let you guys go now. It's 2 hours, 17 minutes. If you have more questions to answer us, let us know. We will have another class on risk management next week. But please watch this thing over and over again. Dedicate 2 hours of your time, buy popcorn and Coke, relax somewhere, and take a note, put it in your mind that you want to learn something. Just close your room and stay somewhere and watch this meeting, because when we come back, we're not going to discuss this one again. We move from where we stop to another level. What you can watch more than 5 times until you begin to get some point. You know what I mean? Yeah. So
Yes,
this is where we end today. We see you guys next week. Those analysis we are making is still valid. The one that's not valid, we'll let you know. But be following us on our page. We will be giving you update on that. And if you need anything personally, just contact us as soon as possible.
All right, sir.
Okay, thank you so much, sir.
So as for the analysis, is the euro USD
Invalid. Let me. If Euro USD has not broken that support, it's still valid. But this year is most likely is bearish. We're expecting bullish. It's already bearish, so we're expecting bullish on Euro USD. We have some buy on Euro USD. On Euro USD. We have not closed some of them. Let me check it again. Euro USD. Yeah, it is still within the same level we shared with you. The analysis is still valid. It's not invalid, but currently it's bearish. For the fact that the market is bearish doesn't mean that we should follow it, because it's already over bearish. Do you understand? It's here.
I have a position on that, and
Yeah, we said at this point is when we can consider it invalid. See this point. Until this point is broken. Remember a lot of support and resistance. Until it's broken, it is still valid. Do you understand what you said? Until that point is broken. Yeah, many analysts is talking about strong dollar. Fine, strong euro going to come up tomorrow. Until that point is broken, our analysis is still valid, because anything can happen. This market can shoot up at any time. So that's why we say stop loss should be below this price until it gains. Now, those stop loss, remember what you discussed about volume now, losses and everything. So everything have to tally. You know, when we say stop loss should be here, it will be below here. You put bigger losses and put stop loss here. You may know, you should be able to know what will be the outcome of that stop loss. In case it hit that point, will it be maybe 10%? Will it be $10? Will it be $30? Will it be $40 loss? So that you know whether this thing is in line with your risk appetite. Is something that everything has to, you know, follow each other. Do you understand? Yeah. So when you go in here now, you see from here below this point, it's like 200 pips. Yeah. So I imagine you're using $1 pip $1, and I told you stop loss below this point, and you're using $100, $1,000 account. That means you're already at 20% risk, or more than 20% risk. That's why we need to make sure that everything marries. In case the market did not gain, it could give you more time to gain. But if it's a lesser volume, even if you go against 200 pips, you just having like minus $20, which is also within your risk until the market started going up again. Then we'll not enter another one from that bottom point. Then again, and start getting that one where the other one is recovering. This is risk management. It's as simple as that. So see you guys next time. We'll stop from here. If you need another information, please just let us know. If lost a seed margin with the trade stop. Yes. Somebody asked a question. Is it Someone was raising his hand. Yeah, if loss exceed margin, yeah, that's where you have a margin call. The trade will stop because there will be a point where your margin, as you can see, that trade was going on minus negative. So free margin is gone, all money is gone, then the trade will start closing by itself automatically because you don't have any money again that's holding the market. Your free margin holds the market, holds the trade. So if your free margin is gone, then the trade will start closing itself automatically because there's nothing again that's holding it. That's what is called margin call or liquidation. So the essence of risk management is never not to lose money. It's not to liquidate account. That's the essence of risk management. There's no way you trade without having a loss, but you can trade without losing your capital. Thank you, guys. Have the best of the week.